Now, before we get into this section, we just like to say, please like, share, subscribe. Your support is always appreciated. It helps us keep this free, if you will. So when we look at what is happening in the EIA and what is happening with demand numbers and what are we seeing on refined products? Because there's a lot of movement back and forth, which is why we always look at that average as well as where are the numbers right now. So when we look at that shift, so as we keep talking about, when we look at 17, 18, 19, we normally get these increases from the end of February into and then peaks in that first week of April, second week of April. And then we see that kind of hold its pattern all the way through. And we're going to get mixtures in terms of what is driving that up and down. So when we look at the average on road fuels and what is I think the most important for what our conversation is, which is that gasoline, jet, distillate, resid, we had a big increase of almost 1 million barrels in demand to come in at 14.561 million versus 13.576. So again, almost that 1 million barrel increase, but it brings us to an average of about 13.992, just below that 14 million. And this is something where we think it's going to continue to have a movement up and down. But again, the trajectory is going to be in the right direction, pulling that average closer to what we think is going to be the lower end of 14 million, call it 14.2, 14.3, just because we do have more driving, we do have more activity. And this is something that seasonally happens. It's a seasonally normal thing. The question is going to be how close do we get back to normal? And we still think right now that there's going to be that standard deviation below, which is going to keep us fairly leveled off, especially once we get past the Easter season, the Easter weekend, in terms of what is the back end of that spring break component. So when we look at what happened in distillate, just to kind of break it into its pieces, here we had a distillate build of 2.54 million, taking us 21.8 million over year, 5.4 million over the 5-year average. And this is what we keep talking about because there's always these shifts. What is happening? And we had really good pace. We were closing the gap, and now we're having that strong bounce over it, back off that low. And this is coming at a time when we're already shifting max away from distillate. So the continuous build is going to be a net problem when you look at that run rate, and it's because we just don't have demand for distillate in the market, especially U.S. distillate, just given the implications that we've seen from European shutdowns, pressure as we keep talking about this knock-on effect, as Europe, is really trying to manage their storage. They're taking less from India, they're taking less from the Middle East and just Asia in general. So then that's putting more of it into our typical markets because the U.S. is a big exporter into Europe. And this is where we continue to see this friction point. Now, imports were down 222,000 barrels a day. As we were saying, we were coming to the end of that distillate surge from Europe into the U.S. So the imports are going to continue to dwindle down, and they're being replaced by a big wave of gasoline imports. So we're just replacing one with the other. And even though we were down 222,000 barrels a day, we were still up 316,000 year over year and 322,000 over the 5-year average. And it's really all driven by PADD 1. So we still have some of that residual. That's going to go away, and then we're going to see that replaced with more gasoline imports. So just to give you an idea, gasoline and diesel flows to the U.S. surged to about a total of about 2 million tons in February. And just based on what we're seeing right now for March is where we're going to get to a little bit above that. And then as we shift into April, which we'll talk about in a few minutes, we're going to get another surge, which is going to put us at about May 2018 highs. When you look at the ships that are coming over, they're in the process. Some of them are already on their way. Some of them will be loading or are currently loading and coming this way from a gasoline side. But again, this is something when you look at the distillate, we expect to see these builds continue to accelerate. And it's happening a little bit earlier than normal because normally this starts to increase in the middle of April. Instead, again, that acceleration to the upside. And when we look at just what is happening on the production level, when we think about what are the refiners doing, well, refiners have a yield, or I should say distillate yield of 31.7%, which is essentially flat on the 5-year or about 0.9% above the 5-year. but down 1.6% versus year-over-year change as they shift into the gasoline market. And again, this is a mixture of imports coming in, exports not going out, which is capping that demand cycle and just impacting the storage level. Because when we look at demand, it's pretty much right within the 5-year average. We don't see that adjusting one way or the other. If anything, we think there's going to be a move to the downside when we look at the export market and we look at what's happening in that demand cycle, just because things are getting warmer. Heating demand is essentially gone now as we go into April. On the diesel trucking side, that's going to remain robust. That's going to be a bright spot. But in terms of just economic activity and some of this growth profile, it's going to be fairly capped at this point, which is again going to pull us down to the downside for the next few weeks. And then obviously looking at the trucking remains robust. Everything is shifting to the upside when you look at just rates. As we continue to see diesel prices going up, this is again pulling those rates up because that is a pass through. And because we have such an issue, which we'll talk about on the Econ show, when we're looking at prices paid, prices received, inventory, supply, delivery times, this is going to keep this fairly bid, which is why it remains at such elevated levels. When we're looking at just that normalization, we're just not getting that normalization on the trucking end. And when we look at load availability, there's just more and more cargoes that are available to go onto the road just to try to get things and just normalize. And that is, again, driving up some of that cost again. Then when we look at the U.S. rail traffic, things are getting a little bit easier when you think about the week over week, this was really when we first had the start of the lockdown. So total traffic is up, obviously that's 16.1%, intermodals 25.8%. The biggest drivers, obviously motor vehicles, as plants were shutting down, and you saw some of those caps. So when we start to normalize things, it's the grains that's going to continue to surprise to the upside. We do have additional slowdowns on the auto side, just because we do have the shortages of chips, but there is that backlog that remains at the coastal sides on the port level, which needs to get into the intermodal. So intermodal is going to continue to be the strong suit. We're going to continue to see that driving up, but maintaining, when we start to average it out over the last couple of years, will remain elevated closer to that upper single digit as we start to look into, well, where is some of this diesel demand going? It's going to remain robust here. Petroleum and petroleum products, and when we start looking at what's happening with oil movements, that's going to continue to be fairly stable at these levels. And if you just think about the year-over-year comps are going to get easier, but when we start looking back to 2018, 2019, it'll still be below, just because we don't have the same demand cycle that we have, just given what we've seen so far in the demand numbers. And when we look at what's sitting at port, as things start to unload, you can see that change over the previous year still remains elevated. That's not going to stop. The Suez Canal had a much bigger impact when you're looking at TEUs in this specific level. Now, it's not going to, obviously, a lot of these cargoes don't, or most of them don't come through the Suez, depending on the route that they're taking. So the bigger issue going forward is going to be how quickly can we get some of this offloaded, because you can see going out to April 17th, we're still well over previous week, still well over previous year as that backlog continues. And when we just look at the importing inflation, this is what we're looking at, because we still have more cargoes coming. We still have that backlog that is due to come through, and it's all going to be at higher prices when we look at PPI and a lot of these other key components. So then when we look at, okay, well, let's round it out, look at that weather side, and you can see that we do have that heat wave that is coming through essentially most of the United States except the West Coast. And this will, again, just minimize the total demand for heating oil, not that there's that much left. And this is just going to keep some of that residual demand coming, just going away. And then we will get an increase in cooling degree days, which will be a little bit of a positive for natural gas. But again, anyone who follows natural gas is really not much positive for it in the near term. So when we look at gasoline, gasoline had a draw of about 1.73 million. It was driven by Pad 1, Pad 2. That's something when we look at the imports, you can see imports were down 320,000, which is down 117,000 year over year, 54,000 week over the 5-year average. That's going to start to adjust. Again, there's always that timing move. So we had that last residual diesel. Now we're going to have that gasoline increase, and then there's going to be more gasoline on the back end of it, which is going to help be supportive. And when we look at that 29-year average, you can see that we normally get these moves down in storage as they continue to trend lower as we go through the spring break and into the warmer months. So then when we look at gasoline storage, we're down 16.3 million versus year over year, down 10.2 million over the 5-year average. And we still have that shift. So when we look at what the refiners are doing, so gasoline yield was up about 1.78%, getting to almost 64% of the yield, which is up year over year by 17.3%. That's going to remain, especially because there's the fact that they weren't operating during the freeze off just enabled the arbitrage to open up, which is why our exports will remain fairly capped. Our imports will be elevated, and then refiners are going to be incentivized to make as much gasoline as possible. So we need that demand side to continue to pull and keep these storage levels from starting to shift up, because realistically here, we think that storage is going to go fairly flat. And as it goes flat, you can see just as the averages dip down, the comps are going to get a little bit easier when we start thinking about storage levels. So we want to continue to see this whittle down and be that bright spot. So just to give you an update for March, as we were saying previously, U.S. imports of European gasoline climbed to the highest in 2 weeks in the 7 days through March 25th, while diesel arrivals dropped from the recent highs, according to the Bill's Landing. Weekly gasoline arrivals from Europe rose to 324,000 barrels a day, which is the most since the week ended March 11th, which compares with 317,000 the previous week. 7 tankers discharged about 1.73 million in U.S. Atlantic coast, with 2 tankers arriving with 542,000 into the U.S. Gulf Coast. Diesel inflows from Europe shrank to just 2 cargoes, again, which is totaling 244,000 barrels versus 1.55 million barrels in the previous week. So that's the shift. We continue to see that shift coming through, which is why we'll continue to see those increases in imports through at least the first 2 to 3 weeks of April for gasoline. Now, with all that being said, weekly gasoline demand continued to remain robust. This is looking at the Gas Buddy data. So the thing that we've been talking about was we were going to get a big spike off of the holiday, better weather, and now we're going to start to see some of this flattening out, and we'll probably dip a little bit, but we think that we're going to set this new level at this region. And then when you look at just the overall demand, there's also going to be that cap from pricing. So not only do you have pricing that's going to be a hindrance, but then you also have, people have already moved. They've seen family that they haven't seen in over a year for some. So again, that's that excitement. But when you look at Gas Buddy, it's going to be where are people pulling from the pump. So it comes down to that cyclical nature of where does it originate. EIA is looking at imports, exports, storage, what's in the pipeline, and then Gas Buddy is looking what are people buying from the actual pump, which is going to really meet at the rack. So this is where we saw that pull through. We continue to see some of this growth, and just looking at what are some of the numbers. So according to Pay with Gas Buddy data, Saturday U.S. gasoline demand fell 2.1% from the prior Saturday, but was 7.4% above the average. Weekly demand Sunday to Saturday rose 2% to fresh pandemic highs, which we're seeing here. Now, looking at Descartes, U.S. gasoline demand rose but 1.8% in the week ending March 26th, climbing to almost, for them, 9.4 million, which extended to the high since the data started collecting from late summer. Now, when we look at the different backdrops, you can say, okay, well, what is some of the IHS market saying? So U.S. gasoline sales trailed pre-pandemic levels by 16%, even after catching the retail amount seen in early 2020 health crisis. So again, this is where we're starting to get to this leveling off point, and we will get that last push. I know myself, I'm going up to Rhode Island for Easter, so this is going to be that last push, but it's when do people fill up is going to be indicative as to when is this realized. So we will see that last push, that'll pull through more. So we'll get one more increase in that EIA demand number, and then we'll start to see that cycle down. And when we look at gasoline prices here, the average in the U.S. is at 285.2, pulled back a little bit as crude kind of normalized over the last few weeks. Coming off about $4. We have the OPEC meeting coming up, which is going to be an interesting conversation, to say the least. We're thinking there's just a rollover where they do nothing. They just Saudi maintains its cuts. OPEC maintains its cuts. There's nothing added, nothing taken away, and it's just going to be fairly stable. So OSPs, or official selling prices, will be more important, because as OSPs come off, that opens up the ability for some of these prices to come down a bit. And that's what we really want to look at, because when we start looking at the year ago level, clearly you can have that base effect number, but the week we're starting to see this steady state. And if we stay here, as we get into Memorial Day weekend, you switch over into summer grade. So that inherently changes the way gasoline is made, which is inherently more expensive. So you get that step up in pricing. And then when you look at Pad 5, as some people on our production team are in the West Coast, you can see that the pain is real. And that actually continues to go up, which is going to be the problem in general when you look at Pad 5 and the reopening of Pad 5. Now, when we look at diesel fuel prices, you can see that diesel still remains elevated. The base effect is still there in the year over year, but we've seen a bit more of a normalization, again, coming from that overhang in diesel, distillate, crude prices normalizing a bit. We don't think it breaks 3, but we think that there is some additional downward pressure, which will be a net positive when you're thinking about those inflation moves into the shipping world. Now, when we look at blending components, you can see that we still remain at that high level. And it's important to appreciate that even though we've had that big drop down in gasoline, the blending components had a drop of 1.96 million year over year, down 15 million, 5-year average down 7.1, because we had that pre-build that was happening in Feb, which is going to eat into some of that margin. But they can import more from Europe and then just blend it and try to make a better margin at the refining level, which is where you can see this is going to stay at those high levels as they continue to target this specific component, especially as we head into the summer driving season. On a 12-year average, we're getting closer to the average in general when we start looking, over the last 15 years or so. We're starting to get a bit more to that level. The one positive when you look at where we are in 2021, we are making that higher high, which is the net positive. But just because inherently miles driven has continued to go up over the last 15 years, we like to look at what is normal, taking out 2020, and let's look at what has happened over the last 5 years. And when you look at the first week of April, that's where you see that surge. So when we look at 19, when we look at 18, when we look at 17, that is where we hit that peak, and then we had that drop down. We just think that we're going to see something very similar on a seasonal level where we get that spike, that spike that came a little bit early, only because, if you remember, Easter's a little bit earlier this year, which means Passover's earlier, all of those things shift to the left, which means that we got that early spike, and then we'll start to see that come down. And we'll see that level off. But we should stay, as you can see, we typically hang out at this higher level, bouncing between 9.2 and about 9.7 million barrels a day. And we just think that we're going to be at a step down of between that 8.5 and probably 9.2, 9.3 as we go through the summer months. So we'll be kissing kind of the bottom of this cloud, but still not getting back to that average, as we still have some of that residual from, infections, some COVID cases increasing in specific areas, and then just what is happening on the vaccination side. Then when we look at propane had a decline of 2 million barrels. That was really driven by Pad 3, as we do have that acceleration on the export level, and then we have some of the residual petchems firing back up to try to capture some of that margin on the plastic side. Right now, we're following about 2017. The low point of this cloud is 2018. Again, this is a seasonal move, so we think that we're going to start to see those increases as you see we flatten out and then start to go back up as heating demand and needs for it just start to dwindle. Again, as we talked about in the distillate section, that's where we're going to continue to see these builds. But there will be an acceleration of petchem demand, which will keep us at below the 5-year average, even when we start to see some of those builds. When we look at the U.S. activity, this is what we were talking about with the increase in COVID cases. It's more sporadic. It's not like it's a national problem. We're seeing some increases in Michigan, some spots of the Northeast, which again is just giving people a little bit of pause, especially as we head into spring break or the end of spring break and Easter break in terms of where some of these contagions are. That's just keeping that lockdown index around 60. So we're still seeing that positive momentum. We still see positive momentum on the vaccination side. So jobless claims is something that we're going to talk about more in the econ show. ADP was a positive number. It was below estimates, but we think that the actual numbers that come out on Thursday are going to be a good surprise to the upside, especially because we keep talking about open table and that reopening on the restaurant front. The one thing that we always talk about is when we look at what is happening with remote work. And this, I think, is a very good chart showing how many companies surveyed by country are looking to have that hybrid of work from home, that flex schedule of work from home, being in the office. And you can see that this is not just a U.S. thing where we're, about 70% of U.S. corporations want this, but this is also Germany, France, UK, India, all are looking to increase this hybrid schedule, which is just going to continue to eat into how quickly we get back to normal. I know on an anecdotal level as well as data level that we continue to see this kickback where a lot of companies were supposed to come back in July. Now it's October, September, October is where we're starting to see that cluster. And this is what's going to keep us from getting back to that normalcy where you still have that residual not happening as much on the weekday as happens on the weekend. So here's just the quote that we've used. A majority of businesses in 5 countries are considering a flexible remote model because of the successful use of video conferencing. So this is from Zoom. Microsoft did the same survey and found that 73% of workers want remote options to continue. So again, it's whether it's from Zoom, Microsoft, from Gallup, everything is within that low 70% range of people wanting it, which is why we do think it will remain in the system. And then when we start looking at the cargo shifts, Russia shipped no Euro cargoes to Asian refiners in March for the first time in 6 months, as a wider Brent-Dubai spread made arbitrage flows to the east less attractive. And this is important because when we look at India here, when we talk about China, we're just not seeing that demand cycle, especially when you had West Africa cut OSPs to on a seasonal level to multi-year lows and in some cases all-time lows to attract some of that flow, which displaced Euro cargoes, displaced ESPO, as well as displacing some Middle Eastern, even though we did get some Middle Eastern flow, which we'll talk about in segment 3. And that compares with the 270,000 tons flowing to Asia in February and 530,000 tons in January. So you can see that steady walk back, which is what's pushing a lot of this physical crude that's struggling to move, which is why, again, when we talk about OPEC, we just don't see any type of increase on production. We think it'll just be, essentially a steady state where they're going to maintain the cuts here. And, we keep talking about this Fed mobility and engagement cycle. And here you can see that this is what we keep talking about when we look at this just general engagement, Fed, the mobility. What are people doing? What stores are they going to? And we think that the weekend is going to continue to push higher. It's down about 1.6%. We think that at least over as things get warmer, we're going to be at least plus 5-7%. It's the one when we look at the weekday cycle that we think that's going to average closer to down 25-27%, which is again going to keep us below that normalcy on the gasoline. level. And we're starting to, and we see that here when you look at retail, recreation, grocery store, workplace is flat. Transit is continuing to increase. And that's another thing that I think was over exaggerated was how people were going to avoid mass transit. As you get vaccinated, the guy next to you is vaccinated. That's going to get people a little bit more comfortable. Not to say that, clearly you can see how far down we still are. It's just getting people a little bit more comfortable, and that's going to be that movement. And then when we look at parks just ripping higher, that's one that we think we get back to these highs again, leading us back to the commentary on weekday versus weekend. Then when we look at Apple Mobility, we continue to sit within this plus 26% in the U.S. This is something that as we saw travel increase for holidays, that'll start to pair off and not really come back to the baseline, but just flatten off as Italy, UK, and Germany continue to be on the lower end. And that's one where we think Germany and the UK will trend a bit down, but not as low as Italy and not as low as France as we go through the remainder of the year of April. So when we look at COVID net changes, the bigger issue that we continue to see is Asia. Asia is on an upward trend that's really being driven by India, which is moving in the wrong direction, South Korea and Japan that are struggling to break that number lower. And then when we look at Europe, you can see that Germany's trending up. Italy remains at the higher end, and the same with France is trending in the wrong direction, which again is keeping some of that stagnant. And the reason why that's a bigger issue is when we start looking at daily COVID vaccinations. The U.S., as of last week, was at about 0.73, 0.75. We're now at 0.85. We've had a big acceleration where the opposite is taking place in Germany, in a lot of the European nations, where they've actually slowed down, and that's coming from the issues in AstraZeneca. We're going to talk about AstraZeneca in an econ show, where now Europeans said that no matter what, they will not get AstraZeneca. They're going to wait for the other options. And then when we look at Asia, Asia continues to be very slow on that rollout, which is becoming that bigger issue when we look at India and China in terms of some of that normalcy. China's been tough because they don't really have outbreaks. They have a little one right now, and they're shutting down a whole city and making everybody get nucleic tests. But because of that, there's also not a big surge to try to get it, which is the government's trying to address. But these are the issues that we continue to see reverberating through not only Europe, but also Latin America and Asia as case counts continue to go up. And then when we look at Jet had an increase, a decrease of a draw of about 170,000 barrels. And you can see that we're pretty much in line with the year-over-year 5-year average. Here we get the surge as we did get that increase in movements as there were more flights added ahead of spring break, Easter break, as we keep talking about, which just means that we will pull back down. We will make a higher low, which is just going to put us, what we keep saying, in this bandwidth that's just going to go up and down, because we do have this steady state now as we start looking at TSA passengers and what they're trying to accomplish. So Delta is now saying as vaccinations are increasing, they're going to start selling middle seats. And this is where we keep pushing back on what the view is when we start looking at TSA. They're going to try to increase the utilization of planes. And it's very expensive to keep them warm stacked, which is why they're going to try to bring back as many as possible, just because of the expense of it. But we need to look at what is the load factor, what is the utilization rates as they try to make these flights as profitable as possible, with the fact that jet fuel prices have continued to move higher. When we look at general departures, you can see just kind of where we are in general. We moved to that high that has been driven by North America. So North America is at the high that's going back for the year, which is, again, that positive. Asia Pacific is starting to flatten out a bit. That's just because we've had some cancellations in some high COVID places. China has continued to see some of those increases. Europe is moving in that in essentially a flattish direction. There's not much going one way or the other. There's a small uptick again for Easter that's going to come back down, while the rest of the world continues to move sideways to down. So departures increased by about 580 flights on average each day at the airports tracked by Bloomberg NEF, which is the creator of the chart. with growth in China and in the U.S. leading the way. Scheduled flights at the airports tracked remain relatively stable from last week, down by around 5% in April, May, and early June since last week. China and Singapore led the cuts. So we're starting to see some of this baseline effect, especially when we look abroad, that we're going to be down about another 5% versus where we are right now. So we get some of the additions, then we get some of the cool off, which is again why we think we're just going to sit within this band as we look throughout. And then when we look at flights a little differently, number of commercial flights worldwide per day, you can see that steady state move up. This is looking at a 7-day average. Now we're starting to see some of this flat line, and which is why we keep talking about that, that percentage or the standard deviation down. We'll continue to close the gap. I'm not saying we won't. It's just we're not going to get back to that 2019 level, especially when we look at tourism, and those are things that we're going to talk about in the econ show. And again, when we look at TSA passengers, we felt we had that sharp drop off, which was really driven based on the drop that was created by, people getting to their destination, that slowdown. And that's where we continue to see living within this, let's call it, a million to about 1.5, 1.55. And we're just going to live within that as we go through the end of spring break. Now, on the open table side, things remain very strong. This is going to continue to strengthen, which is going to be a net driver for new jobs as we go forward, because you can see that we didn't get that low. We've maintained that level. Obviously, kids having off, families going on vacation is going to keep that dip from happening. But we're going to continue to get some of these higher highs, some of these higher lows. And when we look at just the regional breakdown, you can see that on a global level, we're continuing to trend on average about down only 30% versus the previous year. That's really being driven based on what's happening in the U.S., Mexico, Canada, and that's going to be a continuation to the upside. Same with Australia, which is going to keep us at about 30% average. So now that we've covered that deep dive on refined products and how we sit on a seasonal level, now we're going to turn to what's happening in the export market and the global market in general.